It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Hey, welcome back. Another episode. Episode number, I've lost track. I know I said what it was last week. It's either number 104 or 216, or I don't even know. Managing Your Financial Future, Johnny Dean, your podcast host, and with me, one of our usual people, and one that we've never had on the show before. First, I'll say hello to Professor Rick Plum.
Hello, hello. I'm here as always.
Everybody knows you and what you do and who you are. Anything else behind your name?
No, I've worked towards some others, but then I just didn't feel like taking that many classes.
Well, that's probably a good thing. You learn by doing, and so your classroom has been over the years
a lot of experience.
Yes, I would put your knowledge ahead of just about anybody else who just came out of a classroom. In fact, I would put it ahead of anybody else. Anybody who just got out of a classroom needs to now go work for about 10 years and get some experience, would be my opinion. But besides Professor Rick Plum, we're happy to have here with us Jonathan Savona. Jonathan has been with the Lucia Company for a long time.
16 years now.
Yeah. 16 years, and we haven't had you on the podcast, or we never had you on we didn't have you on our radio show, we didn't have you on our TV show, and we haven't had you on our podcast. I thought we'd had him
on something. He's done something.
I've dabbled
Did
a
we
few
have you
times.
on?
Yeah,
I don't know if it was the
TV
show or the radio show back in the day, or he's been on the air at some point in that 16-year period.
I haven't been invited back, so I guess it tells you how well I performed here. But
as the host, I
was afraid of losing my job if we brought you back. So
I should remember that as the host. Well, anyway, regardless of that, it's nice to have you here. You work well. You have your own list. You have your own group of clients. Right. You work very closely as well with another one of our favorite advisors, Janine Stripe, who is brilliant in her own. In her own way. Jonathan, did you kind of come up through her and learn from Janine, whom we've had on the show before?
I did. I did not know anything about the financial planning industry, investment world until 2006 when I started. I knew nothing of the industry and sort of started from the ground up, helping clients and kind of moving my way up from there.
Well, he's also a student of the industry, though. He listens to and reads as much as almost anybody I know in this industry.
I'm telling you what, Jonathan, you and I come in, we do our podcast. I can tell he's a student of everything because he's got stuff in front of him. He's got notes that he's taken. This is how you learn.
He's got graphs. He's got studies.
Did I say that an advisor learns by doing? And Jonathan, this is what makes you one of the top people, if I can say that. And I don't know where rankings are, but learning and constantly learning, I think, is an important thing. And so I wanted to have you on the podcast. We're trying to get a different advisors' viewpoints, not so much because markets are doing weird, crazy things so far in 2022, and we don't know where they're going to go. But we've got all kinds of things happening throughout the world. It's not just in America. It's kind of worldwide. And before we get into this market stuff, we're not in behavior and all that. I wanted to ask you, because we've been talking off the air about this. One of the things that seems to affect people is this whole inflation deal. We're seeing a couple of months here, maybe more, of higher than normal inflation. Demand has outstripped supply post-COVID. I just wanted to get your thoughts. What are people saying? Are they concerned? Are the people that you work with, your clients, your people, are they concerned?
Yeah, it's a timely question. I appreciate you both having me. Big fans. I am a big fan of yours after all these years of listening, finally being invited back. But yeah, I mean, it is a timely topic. I think there is nervousness in the marketplace as clients review statements and see their portfolio values down.
And they go to the gas pumps and see their prices up. Hopefully only temporarily, but they're up.
We know prices are higher. And I think there's good and bad to inflation. The good is that we might have rising wages. We might have a rising home value, which can be helpful. If you're downsizing, moving to Texas, as clients have done. The negative side, of course, being that our dollar doesn't stretch as far. And so I think the conversations really come down to what are we doing with our financial habits and what are we doing with our investments? And so there's kind of two sides to that.
Yeah, you mentioned inflation affects different people in different ways. And I think a lot of it has to do with where they are in life. Is that correct?
That's true. I think, compared to you guys, I might have a little bit of a different, spot in life right now, having 3 kids and now a new puppy.
Whoa.
The expenses have changed and the vacations are slightly more expensive. The grocery bill slightly more
you got
expensive.
a teenage son. No wonder the grocery store's more expensive.
The clothing bill has gone up.
Right.
So, I might need to hustle a little bit harder, but, compared to maybe the pre-retiree or the post-retiree, we have different challenges during this time. And so we all need to have those habits of savings, habits of having margin in our budget and living within our means. And that's basic advice, but it is the advice that we start with.
Well,
no matter where you are.
Are people concerned? I know you meet with probably more retired types or people nearing retirement.
Sure.
Are they concerned at all, or is this something that doesn't really affect them very much?
Well, I think the experience has been that for retirees, we've been through a 2-year period of time where they were saving money, all-time savings rates over the past couple of years.
Well, for 2020, we couldn't do anything.
Yeah, since the crisis began a couple of years ago. And so now they're kind of living off savings, slightly, traveling, buying the new car, doing whatever they didn't do for the past 24 months. And so, I think they feel comfortable at this point, but we definitely want to try to forecast where we're going from here and try to make sure we don't get over our skis with, too much spending. So those are the conversations at this point.
So it's not people coming to you in a panic saying, I need more, I thought I would need this amount of income from my portfolio. I set up my bucket one to do this. We've only been in this inflationary period for a few months. I mean, it's a relatively short period of time. So it hasn't really affected them much other than maybe some minor annoyances at the gas station and things like that.
Yeah, I don't get the sense that there's super fear, ultra panic out there in the market.
Yeah, which is a good thing. And this goes back to the idea of, I hate to keep bringing this up, but proper planning. And this is what we talk about on this show. When we say we're managing your financial future, it's about the present, but it's also planning. And planning, of course, implies that you're taking care of the future. And that's what planning is all about. Besides inflation, the thing that Rick and I have talked about before, and I've talked about this with Terry Keys and other advisors that we've talked about, and I'll bring this up with you, is the whole idea of a volatile marketplace. Now, when you got into the biz 17, how long?
15 years. Yeah.
2006, you said?
Mm-hmm.
Yeah, 16 years. I can't believe
Had
it.
a couple, 1 to 2 years of okay market, and then heck breaking loose when you got into the market.
Well, yeah. So you've seen this. You saw this sort of fairly early on in your career. Probably more severe back then than it is now. But here we go again. And anybody who's been in the business, anybody who's been paying attention over the last 100 years has seen this happen from time to time. Markets that do this. So where are people that you're meeting with? Are they calling in a panic about the market specifically?
I'd like to think that our process of constantly reviewing, their bucket strategy, their numbers, their budget, I'd like to think our process has made them more educated so that we can avoid those panic situations. Sure, we're gonna have some of those, and that's natural. Because values have run so high that now a 10% decline, a 15% decline feels worse because nominally it's much different. When your portfolio has gone from $1 million to $2 million, 5 or 10% didn't mean as much when it was $1 million, but now it means a whole lot. And so when I see a statement that's down tremendously, okay, let's put it in context that we've had conversations about, we've had a bull market for 10 years. Markets have run. We've taken profit. Hopefully part of the plan has been that we've taken profit as we go to fund their safer investments, their income need in the short run. And so hopefully that nimble approach has allowed our clients to have different products with principal protection, of course, does help during this time frame. Something that didn't look so good for the last 9 years now looks fantastic because it's not down at all.
Wow. Like certain income type products.
Well, cash hasn't gone down. We now
Cash
have
hasn't looked really good for a
Isn't
long
that
time.
odd how cash all of a sudden everybody
cash
wants
is helpful. We can now find an interest rate in the CD world. Fixed annuities, fixed index annuities, these are products that can provide some stability to a portfolio during these type of volatile times.
Sure. We've seen interest rates. Okay. I think I'll go back to when you started, interest rates were low, but they really hit a low, I think around 2008-9, stayed low and have continued to stay low probably until at least the beginning
the majority
of
your
year.
career interest rates have been pretty stable on the low side.
Right. So there was a challenge, I know, and Rick's talked about this all those years, of creating some kind of rate of return without going out on risk that's going to help sustain, say, a bucket 2 type. Now that interest rates have come up, what sort of changes do you make for somebody? Is it made it easier to put together a strategy for people? I mean, interest rates are high on the one hand it can be bad, but on the other hand, as you're saying, savings rates can go up. So how has the rise in interest rates, how has that affected your strategizing?
It is the new market. I mean, at this point, to start the year, we really couldn't find anything in the safer space. You really had to stick with cash or something that was very low yielding.
Or accept a little bit of risk or some modicum of risk.
Right. And coming off of 3 years of double-digit returns in the S&P, it didn't sound as appetizing to folks to be that conservative, though after those type of returns, those should be the conversations of refilling something that's safer, no matter what the return is. Sure, it's easier now because we have a positive 3.5%, 4% rate that I could offer over a 3-year period of time. Now, that might be short-lived. We might see that the Fed moved too quickly, and we might have a bottoming of rates here soon. Who knows?
Right.
Who knows how difficult the recession will be? But it's going to affect people in different phases of their, savings life, their income phase, life of retirement. And so it's just a matter of diving into that, situation, that personal situation, and making sure we've covered all our bases.
Does it positively affect? Does a rise in interest rates tend to positively affect people who are savers? I would think it would. I mean, right?
Inflation can be a positive thing because the velocity of money.
Sure, yeah.
In the short run, it can be such a shock to valuations. The markets are moving around from growth to value back and forth. So there's the unknown future that the markets need to try to price in. But over time,
I think they're doing now a lot.
That's what they're doing now. It's resetting the, where companies are going to be valuable in the future.
Sure.
But over time, we see that inflation means you need to be an investor in some form.
And you're not going to beat inflation with cash. So you still have to be an investor on the other side to counteract that impact that is happening on your expenses.
Right. So that's what Buckets does. In the short run, we're trying to beat deflation, and it does, well enough because it's stable.
You're trying to beat deflation.
Sure.
Yeah. We're Explain that for people because
go ahead, Rick. Go ahead. You haven't talked much today. Go ahead, Rick.
Well, I look at bucket one more of making sure that we don't ever have to sell something when it's down to create the cash flow. So I don't necessarily, say it the way you said it, but if I need, $10,000 next year, putting it in the stock market, or if it's in the stock market, means it could be, $12,000 or it could be $8,000. Well, if I need to spend 10, I sure don't want to have to, sell what was 12 to get 10. I don't want to sell anything when it's down. So I'll give up the return, the big return for a year, 2, 3, 4, 5, so that I know that the cash flow, that's what I'm trying. With bucket number one, I'm trying to beat the idea that I never want to be in a position where I have to sell something when it's down. You mentioned the last 3 years being positive double-digit returns and things. I think that's hurt a lot of investors, at least from an emotional psyche standpoint, because they feel that now anything that is at least for those years, you mentioned it, why would they go into something that is safe, that's only earning 2%, 1%, 3%? Why would I ever do that when I can earn so much in the stock market? Well, because this is why, what we're seeing now. Money that we need to spend in the short run can't be near the stock market. Yes, it can work out in your favor. or not.
Well,
And when it doesn't work out, it hurts.
Well, I think this comes back to the question of why are people not panicking? It's funny, and I bet you've seen this. Now, I'm not an advisor. I'm a podcast host, but I don't have the licenses. I understand it, though. And when people say, oh, yeah, you're working, you've in financial services, and one of the first questions they ask me, for whatever reason, is, wow, I bet, how are things? I mean, boy, the stock market, boy, I bet people are all running around, like
chickens with their head chopped off. Things are going crazy.
Yeah, like fleeing, like the residents of Tokyo, and Godzilla's running around. and they tend to have this idea that everybody's panicking. But sure. Do people ask you about that too? Because I don't see it.
I think the value of preparing is that something like this can happen, and if it does, I've prepared and I know where I've prepared. So, like we've talked about, having the savings, having the margin has helped them to realize that returns aren't guaranteed in the stock market. And if we can give them the context going back 2-3 years ago and show them kind of where they were, where they are, and that it's still a positive, hopefully, return over that time frame, then it puts it in better context. So I think it's just being a sounding board, being someone who knows their situation in particular. They're not doing it on their own. I think that's the value of what we do.
Yeah, that's very much being a sounding board. It's natural when you open your statement and you see, wow, wasn't the prettiest quarter or whatever statement you're looking at. And you call somebody who says, remember your plan? Remember why we did this? Remember a year ago when we were moving some money from your growth portfolio over to something more stable, safe, and you were wondering why we were doing that? Because it wasn't going to earn, it didn't have the potential to earn as much.
Why were you putting the brakes on it?
Yeah, why were we taking the cream off the top? I mean, and this is why. Now, we didn't know when it was going to happen. We just know that downturns are going to happen, and you have to prepare for them. Now, if your portfolio is, $2 million and you need $10,000 a year out of it, you really don't have to prepare for much. It's not going to affect you too much. But if you're like most people that need a 4 or 5% distribution off of it, you need to be prepared for these types of downturns.
Yeah, I've seen, it seems to me there's a buckets approach to do this kind of stuff, and then there's the systematic withdrawal approach.
The balanced approach.
The balanced approach, where they will say, okay, buckets, that's complicated, needlessly complicated. I just heard somebody say that like 2 days ago. They had the wrong idea of a buckets. But anyway, they say, okay, all you really need is a 60-40 mix of stocks and bonds. All right? The standard 60-40 mix, 60 stocks, 40 bonds, or maybe the other way around.
Yeah, whatever way they're doing it at that
50-50, something like that. And all you got to do is, sell the stocks when they're, as they're going up, take that income. And if stocks are down, maybe have a couple of years of cash, but if stocks are down, all you got to do is turn to your bonds. Well, what are we seeing now, Jonathan? I mean, are we not seeing a valuation of stocks and bonds both being down?
We are. We're seeing bonds down more than they've been since the 1700s. If there's some metrics I've heard.
Yeah, I don't know who was back there looking at them, but I saw that with 1787. We haven't had this bad of a bond market since 1787. I don't know where that stat came from, but I saw that earlier today.
That's when you could buy bonds from John Hancock himself, right? Yeah. I'm kidding. So when you have a situation like this, I couldn't tell you the last time where we've seen stocks and bonds both.
Yeah, and the difference would be that in a blended portfolio, you might be selling it all at the same time. And so everything's down, 15, 20%. And you're not nimble enough with an approach to avoid selling the larger losses and sell only that which is a bit more secure. Therefore, in the long run, helping the sustainability of the portfolio. Balanced funds are down right now, 20%. Today in July, 2022, as we talk.
So if you're using a balanced portfolio starting at the beginning of the year, you're pulling some money out. You had $1 million to start. You're taking, 30, 40,000 a year out of it.
You're selling stocks that are down.
Well, and bonds, but you're selling your portfolio. Your portfolio went from $1 million to 800,000 without you selling anything. So now you're probably down into the 750, 780 range, and you're still pulling money out, or you have to adjust your spending because of what the market is. And this isn't an unusual issue because back in 2008, the average mutual fund, as judged by Morningstar, average balanced portfolio mutual fund was down like 25.7%, and it took multiple years to recover. So having a balanced approach where it does work quite often isn't foolproof, and it does not work at times.
So you're saying it does work. It can work. I should say when the markets are going up.
Sure,
That's true.
Well, everything's going to work,
yeah.
right?
Right.
I mean, my goodness, as interest rates are coming down, bond prices were going up, and then we saw stocks going up, and everything was great. But this is why I would say, Jonathan, you can agree with me. I would assume you will. Why you prefer a buckets types approach? How does that help mitigate some of the problems that a balanced, systematic withdrawal type of traditional approach? How does that help?
Yeah, I think it's just the consistency that we're looking for in retirement. Is that I've got my main fixed expenses covered with something that is not changing like the wind. I think lifetime income will become more popular as interest rates rise. I think these principal protected options, I'm going to have more discussions because there's actually something to use there. So it's all about that predictability to me. So going back to a cash flow for, a retiree couple, trying to create consistent income for those minimum expenses is where we need to start for a conservative plan.
Yes, you seem to favor. Maybe you're like me, where you like a good guarantee. Here's the G word. But if you have an insurance company guaranteeing or the U.S. government guarantee, you like something. You like something that's got some form of a guarantee like that.
Something you can't screw up.
Well, at least for the expenses, I can't screw up. I mean, there are expenses that I might have more choice over, and I might be okay with variability of return, not knowing if I'm going to use it or not. But for the things, food, housing, those type of things, transportation, I kind of need it to be there
to
live my life.
Oh, absolutely. This is what makes things like Social Security such a valuable part of somebody's overall plan, because you can say that is a guaranteed payment because it is, right? So that's something. But if people don't have enough Social Security or maybe guaranteed pension, if I can use that word again, they need to. You would like to see people perhaps create a little bit more of that.
I think what'll be interesting is if we do have a bounce back in the short run and interest rates stay where they are, we're going to have a little bit more of an option to create, that valuable short-term, investment.
Yeah.
Where we didn't have 6 months ago. Might be interesting to see markets recover a little bit and then have that option to revisit if I need to replenish my safe account in the end. So we'll see how the next 6 months go with the market.
Well,
where it's at.
You guys have both seen where we're talking about guarantees of, let's say, of an insurance company. If you purchase some kind of insurance product that will guarantee you some kind of form of income. Annuities often comes up. Those guarantees are important to people, but of course you've seen the literature on some of these where they say never ever talk about that. I personally, I never ever buy anything with an insurance company type of guarantee. I think that's a problem. What do you think?
Yeah, I mean, just this morning I received from one of my favorite clients, I know she'll be listening to this, about that topic. Another podcast, host talking about annuities. I don't think properly presenting both sides. And I think that's really our goal, is to just educate, present the options and see what fits best, for that individual. Because there are multiple solutions and we got to realize that in the end. So I think we try to put ourselves in a position to have that menu to choose from.
Yeah, so why take it off the table would be my, why say don't ever use this type of...
Well, and the people that say don't ever, and the people, Jonathan had me listen to the podcast as well.
Oh, you heard it too.
Yeah, and the problem was they did take a product that was overhyped, oversold, and I think is a very misleading, deceptive product, and they used that to paint the entire industry.
Yeah, okay.
And so they were being almost as misleading as the marketing for that particular product, the people that are doing the podcast I'm talking about. Let's take the worst product, let's compare every car out there to a Yugo you know,
What's the Yugo? I don't even know
Problem
what
with
that
a
is.
Yugo all of a sudden?
Well, I mean, all cars are
Right.
like Yugos. They're just
Yes.
pieces of junk for all those that are old enough to remember those. That's not fair to compare the whole car industry to a Yugo, or because that was not a well-made car.
Oh, sure. Yeah, there are good products and bad products and all that.
And there are used correctly. There are decent, guaranteed products that that work in the right situation, but they don't work everywhere. Unfortunately, some salespeople sell them everywhere, and so the annuities get a bad rap, sometimes deservedly so, because of the sales practice.
Yeah.
Using it incorrectly.
Yeah. But
the guaranteed income has a lot to do. And there have been studies, and a lot of studies now, the longer we've had this type of planning available to us, studies that say if you have enough income coming across the threshold every month to cover your fixed expenses, the mortgage, the rent, the property taxes, the basic food and light, energy, those things, if you have that coming over the doorstep every month, forget where it's coming from, whether it's pension, Social Security, or some kind of a guaranteed income, you're a better investor for the rest of your portfolio. And actually, it allows you, even though these don't make great leaps and bounds rates of returns, it allows you to be a better emotional investor and stay invested through the bad times, because you're not worried about making your bills. You got your bills covered, so you don't freak out when the markets go down like they do currently have been doing, like they did in 2008-9, like they did in 2000 to 2002, like they will do again at some point, or maybe they'll go further down now. And you stay invested, and the studies have shown that your legacy to ultimate heirs tends to be a little bit bigger because you stayed invested. So used appropriately, not everybody needs an annuity. So not everybody should be looking at it. And
Sure.
so, if you've got pensions, you've got enough Social Security to cover your expenses, don't bother looking at any of these, because they're not right for you.
I think we would all agree with that. We're all kind of on the same page here. I know I know you've got things coming up. We've only got a couple of minutes left. What would you tell somebody out there, Jonathan, who is maybe on the fence, or always figured they could do their own stuff themselves, all their own financial planning, and now that they've seen this whole market thing going on, and they've seen the bonds and stocks and everything kind of really taking a hit, what would you tell somebody maybe who is saying, gee, maybe I should look at a financial advisor? Is there any advice you might have to these people, how somebody might be able to help them?
Yeah, I mean, it can be a complex topic, financial planning. I mean, you're talking taxes, you're talking debt management, you're talking estate planning, insurance. There's so many angles to this. It's not just how do I maximize my investment return. It's not just about that. It's about financial habits. Yeah. And so I think that's, in the end, if there's a second opinion to be had, that's what we do for people who aren't feeling confident that they have it under control. There might be tweaks that can be made. You might not realize you're doing something that you shouldn't be doing, or vice versa. And we can give a stamp of approval on what you're doing. You're doing a fantastic job. Keep doing it. So I think in the end, it's a profession for a reason, and that's what we get paid to do.
And I would suggest that you're not here to get somebody a higher rate of return than anybody else. This is not, I would suggest, this is not what a financial planner is supposed to do. I think a lot of people, some people may expect that out of, if I'm going to hire somebody, I better not be, my stocks better not be down 20%. They better be up 10.
Sure.
Or whatever, right?
I think we're trying to manage risk, and we're trying to achieve goals. And, sometimes it takes some risk management to achieve a goal within itself. So that's what we're doing.
And sometimes it takes a financial plan to show you that you are taking an exorbitant amount of risk where you didn't realize you were taking it before. I see people doing this where they're getting ready to retire, and they want to keep the pedal to the metal and the thing to the floor and keep it going. And they're going to retire in 2 years. But they don't want to pull anything off the table. But now people are doing it more now than they were 6 months ago.
Yeah, it's interesting how that happens. Just as soon as everybody's sentiment changed, everybody changes their mind about things, and now they need the help.
But now's a bad time to be pulling out of the market.
Yeah, exactly. Well, that's a whole other issue.
So understanding what you're trying to accomplish and the risks that are there. A lot of people, they didn't even open their statements for years, and they see all of a sudden their 401ks a year ago were great. And now they're thinking about retirement, and they're thinking, they didn't know how they got there, but now they don't even realize how much risk they have. They took a lot of risk to get there because the market went up and down and up and down, but they weren't looking at it. They didn't care. Now they're going to start caring about it, and they're going to get emotional about it. Now they need to have a day of reckoning to be able to set it up the right way so they don't make inappropriate moves at the wrong time.
And I'm sure you're 100% on board with that, Jonathan.
Yep. Thanks, Rick.
Yeah, that's right. Rick said it very well. Jonathan Savona, thank you so much for being here. I know you got people to meet with, and I don't want to keep you any longer than this, but it's good to have your perspective here. If you want to get in touch with Jonathan, if you're looking to maybe have somebody take a look at your financial plans, you work with Professor Plum on a daily basis.
I do.
Right? Absolutely.
We chat back and forth all the time.
Absolutely. So this is a team effort here. 800-644-1150. That's the number at Lucia Capital Group, 800-644-1150. Talk to an advisor. Maybe just get their opinion. Have somebody to talk to, a sounding board. You don't have a strategy? You should get a strategy. This is what it's all about. Financial planning and managing your financial future. Go on to luciacap.com, luciacap.com, and we appreciate you listening to this program. Spotify is where you find us. Spotify, do whatever you have to do to download. I haven't actually done it myself because I have recordings of all the shows, but go to Spotify. You can subscribe and listen regularly to our program. Thanks again. For Jonathan Savona, certified financial planner professional, and Rick Plum, I'm Johnny Dean, podcast host. Thanks so much for listening. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Fixed index annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum, Jonathan Savona, Janine Stripe, and Terry Keys are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.